$200 billion in suspicious payments. Flowing through a bank branch with exactly a handful of employees, in a country of 1.5 million people. This is how Denmark's largest bank became the center of what's been called the largest money laundering scandal in European history, and how it happened through a tiny branch almost nobody had heard of. Danske Bank is Denmark's biggest financial institution, old, respected, about as far from a rogue operation as a bank's reputation gets. In 2007, it acquired a small Estonian bank and turned its Tallinn office into a branch serving, among others, non-resident customers, foreign account holders, mostly from Russia and other former Soviet states, who wanted a foothold in a European Union bank. That branch was small. What flowed through it was not. Estonia, along with its Baltic neighbors, had become an attractive gateway for this kind of business in the years after joining the European Union in 2004, offering non-resident account holders from the former Soviet sphere direct access to the EU's financial system, with a regulatory environment that, at the time, hadn't yet fully caught up to the volume and complexity of money moving through it. Danske Bank's Estonian branch wasn't unique in serving this market. It simply ended up handling more of it, more visibly, than almost anyone else. Between roughly 2007 and 2015, an estimated $200 billion moved through the Estonian branch's non-resident portfolio, a portfolio serviced by a relatively tiny team, sometimes reported as fewer than 20 people handling accounts for thousands of non-resident customers, generating an outsized share of the entire bank's profit. For a branch that size, in a country that size, handling transaction volumes on that scale should have triggered alarms immediately. For years, according to later investigations, it mostly didn't. Here's the part that doesn't add up. Danske Bank's own internal compliance staff and external auditors flagged concerns about the Estonian branch as early as 2007, the very year the bank acquired it. A whistleblower inside the branch itself, an employee named Howard Wilkinson, raised detailed internal warnings starting around 2013, describing what he saw as an obvious money laundering operation running largely unchecked. Those warnings, for years, didn't meaningfully change what was happening on the ground. Someone was paid to catch this. Multiple someones, across multiple years, apparently did notice, and the branch kept operating largely as before. Investigators later determined that a large share of the flagged transactions bore the hallmarks of classic money laundering, funds moving in complex circular patterns between shell companies with no clear legitimate business purpose, often registered in jurisdictions specifically chosen for weak oversight, tied to individuals and entities later linked to organized crime and corrupt officials in Russia, Azerbaijan, and elsewhere in the former Soviet sphere. The bank wasn't necessarily the intended destination for this money. It was a waypoint, a respectable European Union institution that could make dirty money look, on paper, like it had passed through a legitimate financial system. The Estonian non-resident portfolio wasn't just tolerated internally, for years, it was celebrated. Internal reports and later investigations showed the branch consistently generated returns on equity far higher than Danske Bank's operations elsewhere, and executives at various points highlighted the branch's profitability in internal communications without meaningfully interrogating why a small operation serving non-resident clients was so much more lucrative than comparable business lines. High returns, in a bank's internal reporting, tend to get celebrated rather than investigated, a pattern that shows up again and again in cases like this one, and one worth remembering any time a business unit's numbers look unusually good relative to its size. Part of what let this continue so long was jurisdictional confusion. Estonian regulators assumed Denmark, as the parent bank's home country, bore primary oversight responsibility. Danish regulators, in turn, treated Estonia as the branch's direct regulatory authority. Each side, for years, deferred to the other, and in that gap, the branch kept operating. It wasn't until Wilkinson's warnings became public, combined with mounting media investigation, that the scale of the failure became impossible for either country's regulators to keep deferring on. To put the scale in perspective, $200 billion moving through one small branch over roughly 8 years is, on average, tens of billions of dollars a year, passing through an office that, at various points, had fewer staff than a single mid-sized restaurant. Investigators later noted that individual daily transaction volumes at the branch sometimes exceeded Estonia's entire annual gross domestic product, moving through a unit that operated, for years, with minimal on-the-ground scrutiny from either the parent bank or local regulators. In 2018, Danske Bank published the findings of its own internal investigation, confirming that a substantial majority of the flagged transactions, later estimated around $200 billion total, should have been treated as suspicious and were not adequately investigated at the time. The bank's CEO, Thomas Borgen, resigned the same day the report was released. Danish and Estonian regulators opened formal investigations. So did authorities in the United States, France, and several other countries whose financial systems the funds had likely passed through on their way elsewhere. Danske Bank stock lost roughly half its value in the aftermath. In 2022, the bank agreed to pay just over $2 billion to resolve investigations by US and Danish authorities, pleading guilty to a fraud charge related to how it had misled banking partners about the quality of its anti-money laundering controls in Estonia. Several former Danske Bank executives faced separate criminal charges in Denmark and Estonia. Howard Wilkinson, the whistleblower whose internal warnings had gone largely unheeded for years, later testified before the European Parliament about the scale of the failure, and about how long the bank had known. Wilkinson himself later described a familiar pattern to lawmakers, raising the same concerns repeatedly through internal channels, watching those concerns get acknowledged in meetings, and then watching almost nothing change in practice. He eventually left the bank, and it would be several more years before his warnings translated into the kind of public investigation that actually held anyone accountable. The case became a central reference point in a broader European debate about fragmented banking supervision, the fact that a single bank operating across multiple EU countries could fall into a genuine regulatory gap, with each national authority assuming the other bore primary responsibility. In the years that followed, European regulators pushed for stronger coordinated anti-money laundering oversight across the bloc, though critics have continued to argue that supervision of cross-border banking activity remains inconsistent. Estonia's own banking regulator separately withdrew the Estonian branch's banking license entirely in 2019, effectively ending Danske Bank's operations in the country altogether. Danske Bank's scandal wasn't really about a hidden scheme nobody could have detected. It was about a branch that generated outsized profits, warning signs that were repeatedly raised internally, and a regulatory structure split across two countries, each one assuming the other was watching closely enough. The numbers always tell the story eventually. In this case, they've been telling it since 2007, the story just took over a decade to reach anyone willing to act on it. There's a broader lesson here about what "too small to worry about" can hide. A $200 billion flow through a 20-person branch sounds, on its face, almost too large to be real, which may be part of why it took so long for anyone to fully believe it. Fraud and money laundering investigations often assume that scale requires visible infrastructure, large staffs, elaborate systems, obvious complexity. Danske Bank's Estonian branch showed the opposite can be true. A tiny, unremarkable-looking office can move sums large enough to matter to entire national economies, precisely because its size made it look too insignificant to warrant close attention. A branch with fewer than 20 employees moved roughly $200 billion nobody could fully explain. If you want to understand how that gap between two regulators gets exploited, subscribe.